Hello, chart watchers, and welcome to this Friday, January 12th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. You picked a good day. And for our regulars, welcome back. Today, the market really off to another good start. You can see here, make sure I got the latest. Yeah, you can see the Dow Jones, S&P 500, NASDAQ, and Russell 2000 all performing well. Especially bullish is looking at the Russell 2000 off of a huge day yesterday. We're continuing to see that advance move higher, and the Russell at this point trailing only the Dow in terms of percentage gains. So a very bullish day there among the various indices. 10-year Treasury yield was up earlier. We got a little bit of economic news we'll talk about later, but the 10-year Treasury yield continuing to challenge that 260 area. One area that I like to follow is the consumer discretionary. You can see that we have been on a steady rise in the XLY versus the S&P 500. So we're seeing a lot of relative outperformance in consumer discretionary stocks. Among those, the apparel retailers index having a very strong day today, and media agencies also doing very well today and making a breakout of a downtrend, which I'll talk about in a little bit. Priceline, wanted to mention this stock having another huge day today. It's opened up January 2018 with a very bullish push to the upside, which is a strong seasonal pattern for the stock. And JP Morgan, among those three banks that reported this morning, getting a nice lift off with its earnings report today. And with that, I'll bring in my co-host, Aaron. How are you doing today, Aaron?
I'm doing quite well. It is Friday after all.
It is. And got a long weekend coming up. We'll talk about that in just a second. But yeah, it's a nice day. It's warm here on the East Coast. I'm down just a little bit south of Charlotte, North Carolina. It was 65 degrees this morning. So,
wow, that's warmer than here. It was 51.
Yeah,
but we are getting up to 78 here. I don't know what your high is.
Well, we're going in the other direction, so I don't even want to talk about it after today. We're supposed to be back down in the 20s and 30s again for the next several days. So, just enjoy this today while we can.
Yes. Oh wow. Okay. Well, I mean, it's pretty nice here in California. It looks like the market's enjoying a pretty nice day as well. But
yeah,
I know you have your workshop, so I'm not going to delay anymore because I want to get started, so you have plenty of time.
Yeah, go ahead. We have a couple of announcements, and then you can go through the agenda with everyone.
Sure. First of all, Stock Charts Outlook is this Saturday. That webinar will be hosted by Greg Schnell. You'll want to see that, what his thoughts are. Monday, there is no market running, so we won't have any market watchers live that day. Enjoy your 3-day weekend. And then on Wednesday of next week, we're proud to announce and excited to announce Tom McClellan will be here as our guest. His parents, I believe it was, are the ones that came up with the McClellan oscillator. So it's one of those tools I use all the time. It'll be great to talk to him about the development of that and the best ways to use it. But today, Friday, January 5th, we're going to have the stock market forecast for 2018. Tom's going to do that for us. I know he's got some great charts to show us. 10 and 10 to 1. We're going to start off with Facebook today. I believe Facebook's having a pretty rough day today, so it'll be interesting to see Tom's take on that. Our watch list, we're going to actually go and revisit our Monday setups today and see how they're doing. And I have to tell you, they are doing well. Decision Point report on sentiment today. I'm going to give you the sentiment report. The really interesting sentiment numbers have come out, and I can't wait to show you those charts. But with that, I think I'm going to go ahead and pass it back to you, Tom, for some technical news.
Yeah, I just want to kind of follow up on some of the things I just talked about a couple minutes ago. But before I do that, I do want to mention there were a number of economic reports out this morning. I won't go through each of them individually because essentially they just matched for the most part. Expectations were very close, but we did get reports on December CPI, December core CPI, and then December retail sales, along with the retail sales excluding autos. And all of them came in about as expected. And you can see on the chart that I have here, the 10-year Treasury yield continues to hover up here near 260. It's definitely in an uptrend. I think that's pretty clear. It has been rising since September. And the fact that the yield has been going up tells us that Treasury prices have been going down. So a lot of selling in Treasuries. You want to know one of the reasons why the stock market's been doing so well? Well, part of it is because money is rotating out of the bond market and into the equity market. We've been seeing a lot of selling of Treasuries. We talked about IEF the other day when we had Bruce on, and the fact that we were seeing that head and shoulder breakdown. So we've been moving lower and lower in the Treasury market. And as a result, yields have been pushing higher, and so has the equity market. So that would be one pretty big takeaway as we go into the trading here today. Also, a couple of big earnings reports out today. JP Morgan, they beat on their bottom line, but they missed on their top line. The market doesn't care. We continue to move higher, which I think is very, very bullish. And if you look at a weekly chart on JP Morgan, I'm going to compare JP Morgan's move since November of 2016. Compare that to PNC and Wells Fargo, who also reported today. Here, JP Morgan actually has risen about 67% since the beginning of November of 2016. It's been a huge rise. Of course, we've seen rising Treasury yields. That helps banks in general. And I would say JP Morgan has been one of the leaders. Also, we had PNC report. PNC also has been a strong performer after sideways consolidating throughout most of 2015 and 2016, maybe even a little bit of a rise in 2014. But if you look across these 3 years, really not a whole lot of action in terms of following the bull market. And we did get that breakout in November of 2016, and that has led to about a 60% rise in PNC shares since then. So a little bit less than JP Morgan, but very strong nonetheless. And then the other stock or the other bank that reported this morning, Wells Fargo, you can see a little different story here. We did make a big move off the November low, but we really consolidated quite a bit through 2017, just recently making another breakout. Wells Fargo, since the early part of November 2016, is actually up about 40%. So not all banks are created equal. JP Morgan, obviously one of the leaders. The market is kind of crowning JP Morgan as one of those leaders, and certainly worth considering as yields continue to rise. With that, I know, Aaron, you've got a number of upgrades and downgrades, so I'm going to let you take it away and go through those.
Yes, absolutely. The first one is Kohl's. And when I looked at the daily chart, I had to go to the weekly chart because, it's been a straight up move here after this round bottom. We can see right here the rounded bottom, and then we came back up. So when I pulled up the weekly chart, I noticed this really large double bottom formation on the weekly chart. And we now have gotten a breakout from that neckline. And if you recall from our chart pattern workshop, the way we can figure out what the minimum upside target is you take the length of the pattern and add it to the neckline. So we're talking about a huge move possible here for Kohl's. I don't know if we'll actually fulfill the minimum upside target on this pattern, but surely we're getting ready to come up here and challenge this high from back in 2015. So I'd be watching this one closely. We could see even more of a run up, but at this point, I'd be looking for a pullback to this area of support. The other one.
I was just going to add, Kohl's is part of the retail space, which has been absolutely on fire. And I looked today and I was looking at the top stocks in the S&P 500. And I think 5 of them, like 5 of the top 10, 20 were in the retail space, including Kohl's and Target, Nordstrom's, TJX, and there may have been a couple others. But this is a group definitely that is being looked at a lot differently now than it was just a couple of months ago. And Kohl's with the upgrade today, and also reporting holiday sales that were well above expectations. I think all of that is leading to a lot of bullishness in the chart right now.
Yeah, absolutely. And here's that daily chart, and you can see why I went to the weekly chart, just pretty much heading up straight up into the heavens here. And there was really nothing to compare it to over here. It had been basing for quite a while. Let's go ahead and look at another upgrade, Dick's Sporting Goods. And again, we're looking at more retailers, aren't we? So great chart here. Here's your gap right back here. And I'm going to do a quick annotation here so we can really see it. So there is where you could look for some gap resistance here from back there. And look what's happened today. Nice breakout above that gap resistance level. And at this point, where would we start looking to go? I would look at this level at 37.50 as your next signpost along the way up. You can see with the PMO, yeah, it's overbought. This isn't necessarily where personally I would be getting in, because this wouldn't be showing on my radar. I prefer to get in not when the PMO is running near its top. However, depending on your strategy, could be a good buy. But for me, I don't like to see an overbought PMO, but we do have a PMO buy signal. It has come in on this breakout. So looking pretty good there. And let's go and take a peek at another upgrade. And this one we have is, there we go, Motorola. This is another big mover. If I recall, I think it's one of the big scooter movers today. Not a surprise. You can see that nice move going on there. Look at the PMO buy signal coming in right above the zero line. Really nice. I love to see that. If I'm looking for an investment, my scan would have probably brought me in a little bit earlier with that bottom that had set here on the PMO. And remember, my scan, I like to catch bottoms. So I look for when it was falling, and then I scan for when it's been rising for 2 to 3 days. And so that's when it comes in, and generally it'll get you in a little bit earlier, which is why I tend to use that as my particular trading style. But I do know people who are a little more cautious, and they do wait for those buy signals. But look at this, it's a really nice breakout. And I'm putting this at the last last close that was at this top rather than at the top of the OHLC bar, mainly because you can see this gap up has brought us right above that area of overhead resistance. And typically when I see these consolidation patterns, just for my own measurement, I don't believe this is an official thing, but I measure the length or the height of the consolidation pattern. I start looking for that as my upside target. So I think this one looks pretty good on the upgrade. And I've got one more upgrade here. I believe that's Humana. Yes. All right, another nice breakout. Here we go again. Would have probably gotten in on this one a lot earlier with that round bottom, or even on that PMO buy signal. You still would have managed to catch this uptrend. You can see OBV going the right way. Look at the PMO bottoms in confirmation to the price bottoms. Really nice. So I'm going to annotate this so you can, again, actually, I'm going to take us to a weekly chart, see whether there's some overhead resistance here. Not really. So we're continuing to make these all-time highs, at least for the last, I'm sure it's probably all-time highs, but we had that nice breakout. Look at the weekly chart too. We're getting ready to have a PMO buy signal on this. So in the intermediate term, this could be something to look toward. Let's see, downgrades though. I do have 2 downgrades. One is Etsy, and everybody knows that's been my darling for a little while. Since hitting that high though, back at the end of December, it's been really trailing lower. And today we're getting a full gap down, breakdown below that 20-day EMA, seeing that 5 crossing below the 20. As I told Tom, I had added a position, and I'm going to probably jump out at this point. I might wait and just see if we get a bounce off the 50, but our support level, the strongest support levels here at 18. So, and I did buy above that. So I prefer not to have to sell it too soon. I would like to see it bounce back, but after a downgrade, it does worry me. So I'm probably going to bail out of that and free up that cash for something better. That's how I look at it. All right. Looking at Snap, it was also downgraded. I've still been kind of wondering, well, it's like Facebook, how Snapchat was going to become a huge deal. I know they're doing more advertising, I guess, but I have a Snap account, but it's like Twitter for a lot of other people. I just don't use it. It's It's great to keep up with your kids, though. I have to say that's really the only reason I signed up. And honestly, I'm kind of wishing I hadn't. I don't. Some of this stuff I don't really want to know. But anyway, we've got a PMO sell signal going on here. We've hit this area of support, but you can see the 20 is getting ready to cross below that 50 with the downgrade, with the PMO sell signal. I would not be holding on to this, and I probably would have had to stop at 13, if not at 14. So it's not looking too good at this point in time. And with a downgrade, I wouldn't expect things to get too much better. But with that, that's all the upgrades, downgrades I have right now. And Tom, I know you've got lots to cover, so I'm just going to pass it back to you, and let's get started with your forecast.
All right. Let me get everything set up. Yeah, we got a ton to go over today. I'm going to start off really just by going over the major indices here, in particular the NASDAQ and the S&P 500. This is a long-term chart of the S&P 500. And you can see back since 2009, we have clearly been in a bull market. And, you know, I think there are a lot of folks here at Stock Charts that follow technical analysis that generally view an uptrend as an uptrend until it's not an uptrend anymore. And so I think you have to really be careful about getting too bearish or too cautious moves to the upside when the market is giving us no signs that this is ready to quit. I know, you know, when you look back at history, bull markets tend to last a whole lot longer than bear markets. Bear markets tend to be very swift and scare the heck out of everybody. And by the time it ends, no one wants to see or touch a stock again for quite a while until that bull market kind of reverses and it's kind of a rinse and repeat kind of cycle that we go through. But I can't tell you when this bull market is going to end. The prices will tell us. And right now, I see the S&P 500 continuing to go higher. I know on some charts, especially if you don't use the log charts, the move to the upside can look very, very strong. But I think if you do use the log charts, and what I'm talking about is this log scale down here under the chart attributes, I always use the log scale. And by using the log scale, just to give you an example, a move on the S&P from 700 to 1400, the distance that you see looking vertically from 7 to 1400 is the same as from 1400 to 2800. So it kind of takes into account the percentage moves, because otherwise, and just to give you maybe a little perspective, let me take this off and show you what this looks like. Now here, it looks like we really didn't make much of a move back here, and all of a sudden we're just taking off in 2017. I think that's the wrong approach, personally. I think you need to take a look at it from a log scale perspective, because from a percentage standpoint, going from 2,700 to 2,800 is not nearly as high a percentage as going from 700 to 800 or 800 to 900. And so, again, I think that you need to put it on a log scale to get proper perspective. But there's the S&P 500, nothing wrong. I mean, technically, in terms of price action, we keep moving higher. Here's the NASDAQ. I don't see anything wrong here. We just keep moving higher. I mean, if you're investing in the stock market, I think this is exactly what we want. We want to see. We want to see the market continuing to go higher. So again, I see an uptrend. The XLY versus XLP, this is a ratio that I like to follow that just compares the performance of consumer discretionary versus consumer staples. And the big reason I like to follow this is that when we look at the GDP, 67% of it, or roughly 2/3, is made up of consumer spending. So it kind of makes sense that we really want to keep a close eye on which consumer stocks are performing well. When we're in a bear market, as we were in 2007 to 2009, you tend to see this ratio going down. Same thing, 2000 to 2002. Bull markets, you tend to see this ratio going higher. Now, we had warning signs back in 2005 to 2007 when we got through, went through that housing bubble, and then we had the financial problems on the back end of that. But you can see that this ratio really struggled. We were going higher throughout the bull market, but then the latter stages of the bull market, especially when we got toward the end of 2007, look at the top of the bull market didn't come about until early October 2007. And by then, we were actually breaking down on this ratio to multi-year lows. So money was starting to rotate toward consumer staples as opposed to consumer discretionary. You don't want to see that in a bull market. Take a look at what we're seeing right now. First of all, we've been moving higher, and this ratio doesn't go up every day. I've heard people say, well, the stock market's up today, but consumer staples are outperforming discretionary. That's a lot of noise. I'm looking at the big picture, just like I would a chart on a long-term picture. I want to see moves higher, consolidation, moves higher, consolidation, moves higher. Money continues to rotate towards consumer discretionary, and I find that to be very, very bullish. Down at the bottom of this chart, I have a correlation that shows the ratio of the XLY versus XLP and compares it to the direction of the S&P 500. And I think you can see that this sits above zero almost the entire time in this century. So for the last 18 years, we have spent most of our time, almost all of our time above zero, and a lot of it near one, meaning that these two tend to go hand in hand through long periods of time. So when the S&P 500 is going higher and the XLY versus XLP is going higher, it tends to indicate a sustainable bull market rally. And so what I'm seeing now with a breakout to all-time highs, how am I going to get bearish? I mean, I'm seeing not only the market moving higher, but I see money rotating into the more aggressive area within consumer discretionary. So I find this to be a very bullish chart. Next, I want to go through the various sectors. So we took a look at the major indexes. We took a look at one of the key relative ratios. And now let's take a look at some of the aggressive, or let's take a look at all of the aggressive sectors. I want to make sure that these groups are participating in the rally to the upside. I don't want to see a rally that ignores technology, the industrials, consumer discretionary, and financials. The more that are ignored, the less I'm going to feel good about the bull market. So here we've got the XLK. Now, the way these next few charts are set up is you'll see the absolute move on the ETF, the sector ETF. So this is just giving you the actual price move. Down below, it's the sector ETF divided by the S&P 500. So it's a ratio. So it tells us not only that technology has been going up for the last 9 years, but that we continue to move higher on a relative basis, meaning that technology is outperforming the benchmark S&P 500. Now, you will go through periods, and you'll see on these next few charts that occasionally you will get periods where some of these groups fall out of favor. I don't want to see them all fall out of favor, and I really don't want to see the majority of them fall out of favor, but occasionally to see them kind of unwind after they've made big relative moves, I don't typically have a problem. I tend to follow this very similar to a price chart on a stock, where I want to see higher highs, and then when it comes back down, I want to see it hold the prior low before it starts to move back higher again. I don't want to see relative breakdowns. So I think when you look at technology, I think obviously the absolute chart looks very strong, and on a relative basis, I think you can see that technology has been leading this rally to the upside. At some point, we're probably going to go through a period like we did in 2012, 2013, where we're going to see technology put the brakes on for a little bit. It doesn't mean that the stocks are doing poorly. I mean, if you look at this period for a year where the relative strength declined, technology didn't do bad. It was just that it was going up a little bit. And if you recall, the S&P 500 took off in 2012 and really started running in 2013 and 14. So when it first started, technology was going up. It just wasn't going up as fast as the overall market. So money was just kind of rotating into some other groups that were going up much faster. Then technology saw that money rotate back in, and voila, we're back off to the races again. So I think that technology continues to look strong here. In a similar vein, I'm going to take a look at the industrials. Again, here is your top absolute chart. We continue to move higher. And if you look at the relative strength, we just continue to put in this series. We do go through periods where we pull back on a relative basis. But again, we don't make any price breakdowns. We make no relative strength breakdowns. But when we do break out of relative weakness, like here for 2 years, the XLI didn't do a whole lot. But then once we broke out in 2013, you can see the move to the upside was strong, and it outperformed. Go through a couple years where it's underperforming. Again, doesn't break down. It's going sideways, and it underperforms the S&P. But then we get a relative breakout and check out what happens. And right now, I think we're looking very strong in this area as well. Next up, consumer discretionary. Now, consumer discretionary has for the most part led throughout this bull market, but a lot of traders have short memories and they just look at the last couple of years. And of course, consumer discretionary hasn't done that well on a relative basis. It's been pausing, just like it paused in 2014. Prices kept going higher, and even here during 2 years, you can see we had a relative downtrend, but prices kept going up. They just weren't going up as fast as the S&P. Now look what's happening. We are getting a huge rally on a relative basis in addition to an absolute basis. And this is really important because when we've seen big moves in consumer discretionary before, many times the relative move to the upside begins with a bang. And so this to me looks like the start of something that is likely to continue throughout 2018. I'm a big fan of consumer discretionary as we go into 2018. The XLF financials. You can see again, here's your absolute performance, been strong, but on a relative basis, for the most part during this bull market, it just goes along for the ride. And I'm okay with that because financials, what I'm most concerned about with financials are the banks, life insurance companies, asset managers, investment services. Those are some of the key areas. And they're not high-flying groups. I mean, maybe investment services sometimes can kind of get on a roll. But for the most part, these are groups that do well. You want to see them doing well. You want to see them going along for the ride with the S&P 500. Because if you think about it, the banks really are the heart of the financial markets. And as long as the banks are doing well, they'll continue to lend. And credit availability is huge to the stock market. As we saw back in 2007 to 2009 when the market fell apart, credit availability went to almost zero, and the entire economy just about shut down for a period of time. And of course, then we had the Fed step in. But here you can see on a relative basis, we're actually getting some pretty good strength out of the financials. So when I look across these four aggressive sectors, I am not seeing any absolute price weakness, and I'm seeing no relative weakness. I see strength across the board. So I can't go into 2018 with a bearish mindset when I see money continuing to rotate the way it's been rotating. Next, I want to talk about an area that I am not a fan of. And I know I could debate this with a number of folks at Stock Charts. And that's fine. A market is made up of two sides. And I'm certainly wrong plenty of times. I may be wrong again. But I'll tell you why I don't like commodities as we go into 2018. Before I go into 2018, let's take a trip back through history. Here is the CRB index, which is basically, it's one of the most widely followed commodity indexes. You can see the huge move that commodities made back in 2002 to 2008. So the last bull market, it went crazy. But this bull market, it's going down. So what's the problem? What's the difference? Well, there are a couple things. Number one, here is the CRB relative to the S&P 500. So you can see the move on an absolute basis was pretty consistent. And we did have periods of very strong relative strength. I mean, I would say looking back, 2002 to 2007 was a great time to be in commodities. But we were, for the most part, continuing to move higher with just a couple of exceptions. We had a little brief period 2003 and a little bit of a brief period for about 6 months 2006. Other than that, we were rising on a relative basis, meaning that commodities were outperforming the S&P 500, and that's great. So why were the commodities outperforming the S&P 500? Well, the dollar is there's a tremendous correlation, inverse correlation between the dollar and commodities. So anytime you got the dollar index going down, that is typically a tailwind for commodities, and we see commodities outperform the S&P. But since we bottomed back in 2008, we really, I think, are still in a longer-term uptrend. Now, I know there could be a lot of arguments here. 2017 was not good for the dollar. It's come back down. We're at a 3-year low. But this is following a steep rise back in 2014 and 2015 that cleared a couple of really key resistance levels on the dollar. We have not broken those levels to the downside. In fact, there's a trend line that comes in right toward the bottom here to about 88, 87.50 to 88 on the dollar index. If this breaks to the downside, I would grow much more bearish the dollar and I'd grow much more bullish commodities, but we haven't broken that yet. And I would be really careful. Now, when you look at the commodities right now, and I know, we've had a pretty good move recently in some of the commodity areas, but when you look at the CRB relative to the S&P 500, is this an area you want to be in? Because on a relative basis, it's been declining for about 9 years. And I don't see any turn up yet, even though we've seen nice push here in early 2018 and certainly a big move in December of 2017. Where is it showing up in terms of relative strength? The S&P 500 has also been going higher. So I look for outperformance. I mean, I don't look for something that just goes up. I want something that's outperforming the benchmark S&P 500. That's where I want to concentrate my investments. And I see no relative strength yet. And as I mentioned, I don't really see a breakdown longer term yet in the dollar. Short term, even intermediate term, yes. And so could this be the start of something that breaks down longer term? It certainly could. And if you want to make that bet, and it turns out, it'll probably work out great for you. But if this uptrend, this longer term uptrend holds, then I think commodities are going to struggle on a relative basis. I think there is a reason why this group has been so weak over the last several years, especially since 2011. And the biggest part of it is that we have continued to see a rise in the dollar. So why do I think the dollar is still going up or is still in an uptrend? Well, John Murphy has written some really good stuff about comparing. Well, let me back up for a second. Economics 101, when I was in school many years ago, I don't want to date myself, but many years ago, I was always taught that the dollar would strengthen when interest rates went higher. And in part, that's true, but we've grown into a much more global environment since I went to school. And it's not so much now just what U.S. interest rates are doing. It's what the U.S. rates are doing relative to the rest of the world. I tend to use Germany just because there seems to be a really tight correlation between what happens here in the U.S. and what happens in Germany. Feel free to use a basket of foreign 10-year treasury yields or pick another country. That's fine. But for me, what I watch is how are the 10-year treasury yields here in the U.S. doing relative to Germany. And you can see that since 2009, we have continued moving higher. I think it's pretty clear to me, at least, that we are still in an uptrend. Now, there are periods when this goes higher and the dollar goes lower. But for the most part, I think you're going to see that there tends to be a pretty strong correlation between the two. I pointed out about a year in middle of 2013 to middle of 2014, where the yields were rising faster in the U.S. than in Germany, yet the dollar pulled back a little bit. And then the dollar caught up with a huge move, and the ratios continued moving higher, or the difference between. And for those of you who maybe can't read this, let me this is the dollar UST 10Y minus the dollar DET 10Y. And that'll give you the difference between the treasury yields here in the US versus Germany. And then it's plotted on the chart here. And all it's doing is just showing the fact that US treasury yields have been going up faster than Germany. Maybe that ends. And if this breaks down, this uptrend breaks down and we take out the prior lows, I will definitely change my tune on what I think is going to take place here in the market in 2018 and beyond. But for now, I'm going to stick to my guns. I think that the treasury yield is on a rise. Not only is it rising here in the U.S., but I think it continues to rise faster than what we have seen in Germany. And as long as that continues, I'm going to really find it difficult to believe that the dollar is going to weaken considerably. And if the dollar doesn't weaken considerably, how are commodities going to get that tailwind to go higher at this point? So it's not that I'm saying it can't happen. I just need to see more evidence that the dollar is going to fall. Here's the CRB. Here's a big chart. CRB versus the S&P 500. Here is the move down back in the late 90s. Here was the nice little bull market we had through 2008. And look at where we are currently. Now, I don't know where we are. Could we say that this is, back here in 1999 and we're getting ready to make this big move like we did then? I suppose. I don't see anything yet on the chart that tells me that. In fact, we're pointing straight down right now. So again, a trend is a trend until it's not anymore. And I just don't see it at this point taking a chance on the commodities. So then let's take a look at gold versus the S&P 500. Here's gold. Big move down into 2000, huge rally through 2011. And you can see that during that huge rally through 2011, the dollar was in a downtrend, continuing lower. But once we hit basically a double bottom in 2011 and we started this uptrend in the dollar, gold has been going down. This is gold relative to the S&P 500. Let me clarify. So you can see that during 10-year period for this decade, not only was gold soaring, but it was a much better investment than the S&P 500. This line, which continues to point down and even today is setting a new low, is telling us that gold on a relative basis is not a better asset to own than the benchmark S&P 500. And so again, when I look at the chart, yes, short-term gold looks pretty good, but guess what? So does the S&P 500. And on a relative basis, I think this chart says everything I need to know. All right, a couple of industry groups that did extremely well in 2017. I want to point these out because I think history is a great teacher. And renewable energy was downtrending for 2.5 years before it finally made a breakout. And I'm going to say what you call a breakout depends, I guess, on how you look at charts. First of all, normally in an uptrend, prices stay above the 20-week moving average. And normally in a downtrend, the action is mostly below the 20-week moving average. So one thing that would get my attention is having lower prices, a higher MACD, which is a positive divergence, and then crossing above the 20-week moving average. That would be a very early signal that perhaps we're seeing a major turn in the renewable energy. But once we get a golden cross with the 20 moving above the 50, that pretty much sums it up for me. And then you get the crossover, MACD crosses over the center line, and this is the definition of a strengthening market. Anytime you've got your MACD rising and it's above the center line, it's telling you that the bullish momentum is accelerating to the upside. But you also could maybe draw a trend line down here and say maybe it was mid-year. Whatever you call it, I think everybody would probably agree at this point that renewable energy has broken its downtrend and is trending higher now. This was the best performing group in 2017. So when you see these breaks, it's worth noting because once it starts to make a move like this, again, for me, I'm looking for outperformance above the S&P 500. And this was the best performing industry group in 2018 after it made a series of bullish turns back to the upside. Next up, home building. If you look at the long-term home builders, we were basing for a long time. This wasn't a downtrend. This isn't what we looked at on renewable energy, but this is a group that basically for 3 or 4 years went nowhere, sideways, didn't do anything. Then early in 2017, from sideways consolidation, a very long basing period, we broke out. And that preceded this huge move in 2017. Another group, commercial vehicles. Look at this group. 2014 through 2016, it was downtrending. But notice that as we broke above the 20-week moving average, that started to hold. Now, in the past, during this downtrend, when we would break above the 20, it wouldn't hold. We'd come right back down. We get a temporary break above, we'd come right back down. It starts to look much more bullish to me when we break above the 20, we come down, test it, and then break to new highs. And this is what we have been doing straight up for the past 2 years in commercial vehicles and trucks. So again, what I'm looking for as I look out, and I'm going to go through a bunch of charts pretty quickly on industry groups that I like as we go into 2018. Some of them maybe are already somewhat strong. Many of them have been underperforming for a while and look to me like they're poised to break out and possibly lead to the upside. So I want you to keep that in mind as we go through. First one for me is the Broadcasting and Entertainment Index. Downtrending to end the year. We made a big breakout here, and some of these, probably most of these, I'm going to pull up a weekly chart. This is a group that back in 2015 was at 1,200, and 3 or 4 months ago, it was at 1,200. So again, here's a 3-year period, or actually 2-year period, where prices went nowhere. Now we're threatening to make this breakout. I would be watching that rising 20-week moving average. I think Broadcasting and Entertainment looks strong. I like Disney in this space. The media agencies, I love this daily chart here with this downtrend being broken back to the upside. We're actually trying to clear the most recent high. We've printed higher low, and now we're moving to higher highs. And let's take a look at the weekly. The weekly, what are we doing? We're just now breaking back above that 20-week moving average. And if you look back for the past year, or almost a year, we haven't had any breakouts. Looks like maybe in July we made a very slight move above the 20-week moving average. But clearly, this is the most bullish that this index has looked in a while. And if you look at where we are right now, compare where we were back at the beginning of 2014, we're not even where we were then. So could this group be poised for a major rally in 2018? I think so. It's certainly one to keep an eye on. I don't have individual stocks on each of these, but I will talk about them in future sessions here on Market Watchers Live. Let's take a look at footwear. Footwear, big breakout above recent highs. So on the daily chart, I think everything looks pretty good. But let's take a look on the weekly chart. Beautiful move up, continuing to strengthen along the way. And I think just putting in the right side of a cup. We haven't made a breakout yet, but if we break out, you can already see the strength in the 20-week versus the 50-week moving averages. Check out the weekly MACD here, which is incredibly strong. A breakout above the 1250 area would be really bullish for this group, and I do like Nike. The apparel retailers, talked about this a little bit earlier, kind of highlighted them at the opening market update. But you can see the breakout recently, went back down, tested it beautifully, and now we're trying to get another breakout. May sideways consolidate in this area and kind of let things settle down a bit. But overall, this group, this move over the last 2 months has been very significant. And once again, if we take a look at a weekly chart, check out what we're looking at here. Even with this huge rally, we still haven't gotten to where we were at the top back in 2015. And I know a lot of folks have written off retailers because, the malls are getting smaller and everything's going online. You got Amazon, you got this, that. Well, every time you get a group in a downtrend, there's that kind of talk. But when you start seeing the price action speak differently, I would ignore the talk, ignore the noise, follow the charts. And this was a group all the way into 2015 that was doing extremely well, leading the bull market, and now kind of fell upon hard times for 2 or 3 years, and the group is definitely strengthened here. You could make an argument that we still have some work to do, some overhead resistance, but I don't think there's any arguing that this is a very nice uptrend the last 3 or 4 months. This is a group that could do very well in 2018. Delivery services, moving on now to the industrials. Delivery services, nice breakout here. Beautiful flag, move up, sideways, and then break out. Let's pull up the weekly. Pretty much, again, sideways consolidation. We have gone up. So this is one of those that you could put in the category, well, it's already gone up some, but not like the overall market. And the one way you can tell is by simply putting in a colon and the S&P 500 symbol, $SPX, and take a look here. And you can see we have not been outperforming the S&P 500. If anything, maybe slight underperformance. That's and maybe best case just kind of going along for the ride. But this has not been a group that's been leading. So now that we're starting to get this really strong price action, it could be the signal of something pretty big in 2018. Transportation services, daily chart sideways, breaking out, looks good. Let's go to the weekly. And look at the sideways consolidation, maybe even an inverse head and shoulder pattern with now a clear breakout. Look for more strength here. Airlines, been talking about this one recently, wrote about it in the my Trading Places blog earlier today. But you can see on a weekly chart, this is a major area of resistance. We're sitting right now at an all-time high, just breaking out above a level that we've been either at or close to for the last 3 years, 3.5 years. And finally, it looks like we're getting a breakout. Computer services, moving on to technology. Nice little breakout here. Of course, when we think technology, we think internet, we think software, semiconductors, computer hardware. Those are areas that have been leading the market. And I'm not trying to say that the areas that have been leading the market are not going to perform well. That's not what the purpose of this exercise is. It's trying to find new leaders in 2018. So taking a look at the weekly chart on computer services, again, look at the sideways action, but now all of a sudden we're starting to get some very bullish action where not only are we breaking above the 20-week moving average, but we're holding it and starting to rally off of it. Mobile telecommunications, I've talked about this one recently, but let's take a look at the weekly chart. We've got a downtrend that's been in play now for several months, and we're really not too far above where we were 3 or 4 years ago. So I think if this downtrend were to break, and I've been talking about 330 being the level, we got right up to it. It's kind of where the big drop began from back in October, November. But now we've gotten back up to 330, tested it, pulled back. I want to see a move, a sustained move above this 20-week moving average, and a push above 330 would be very bullish. Let's move to the financials. Life insurance. Talked about this one earlier. Here's the latest breakout. Clearly uptrending. And if you recall, 10-year Treasury yield bottomed in early September. Life insurance, banks in particular, those two groups really love to do well during periods of rising Treasury yields. Take a look at the weekly chart, and you can see after a lot of sideways consolidation, this one broke out when we had the major bottom in the 10-year Treasury yield. But we did consolidate through much of 2017, and now we're trending higher. This is one that probably, again, isn't going to be the leading group because these financials don't tend to be those kinds of movers. But I do expect that we're going to see outperformance above the S&P 500 in life insurance. Real estate holding and development has pulled back recently, maybe on a trend line support. But from a weekly perspective, look at the level up here at 105. We're going back 3 or 4 years. So keep in mind a breakout above 105. We're starting to act more bullishly here with that 20 pulling away from the 50. The MACD looks good. So each time we test this rising 20 and hold, I'm going to feel more and more bullish about this group. A breakout above 105, though, on a weekly basis clearly would be extremely bullish for the group. Banks. Here is the latest breakout on the banks. And if we go back and look at a weekly chart, it's going to look a lot like the life insurance, where we went sideways for a few years, finally made that break to open up November 2016, sideways consolidate throughout much of 2017, and now here we go, breaking out again. I think this group looks good. Energy. I could pretty much just throw a blanket over energy because we were downtrending for a while. I'll go through these charts very quickly, but on a weekly basis, you can see we are in a serious downtrend. This has been a big move. Now, where does it end? I don't know, but as long as it continues to trend higher, I'm going to be fairly bullish. A breakout on the oil equipment and services index at about 550, right up at this level, would be extremely bullish in my view. I think we're going to go up and test it. Then we'll see. The integrated oil and gas index, pretty obvious. We've been having a really nice run here. Again, moving on to the weekly chart, we have made that multi-year breakout in this group. I think that's a very bullish development. Also check as we moved up. One of those early clues is when you pull back and hold on to that rising 20 and get that golden cross. That is typically a very bullish development, and it was here. Exploration and production, another one clearly trending higher. We take a look at the weekly chart, and the downtrend has broken. We're moving higher and also trying to clear that late 2016 high. Steel, beautiful move up. But again, take a look at the weekly chart. Looks like maybe we can't go any further on that chart, but we were going sideways 3 or 4 years on steel. And finally, after having double top, close to a double top around 270, 280, we have made the breakout. A little stretched, but certainly any pullback to test that rising 20-week would be interesting. Non-ferrous metals, beautiful move up. Looks a lot pretty similar to that steel index. And then you can see here, though, very significant breakout recently above 225, moving to multi-year highs. I think this is a group that still looks poised for further gains in 2018. Getting close to the end here. Moving on to healthcare. Pharmaceuticals, rising of late, trying to get up to this area. On the daily chart, maybe it doesn't look like such a big deal. Tell you what, though, on a weekly chart, if the pharmas can make a breakout, this was a group that was leading the bull market until 2015. We have been going sideways for a while, had a little bit of a false breakout, came back down, and now another breakout above 550, I think would be very bullish for pharmas. I think J&J looks really good in this space, which is Johnson & Johnson. Biotechs, been a fan of biotechs for a while. I think we're in the right side of a cup, which is much more apparent in a long-term trend. Here is a big leader of the bull market earlier, through 2015. And now we have been doing this whole rounded cup kind of thing. A breakout above 2,200 eventually, though, would measure to 2,900. And this group tends to move very quickly. Consumer staples, this is the last sector. The brewers, I've talked about this one recently as well, starting to act very bullish here on the daily chart. And the thing is, on the weekly chart, we have climbed back above that falling 20-week moving average. And we are on the verge, if not already, breaking this downtrend that's been in play for about 15 months after coming back and testing the price support where we had broken out back in 2015. So the Brewers Index, I think, looks really interesting. Now, it is part of consumer staples, so it's probably not going to be a huge, real fast mover. But I think this one's got a decent chance to outperform the S&P in 2018. And I like Molson there, TAP, TAP. Food retailers and wholesalers index, sideways consolidation. Nice little flag trying to make a breakout here on the daily chart, but the weekly chart really looks good after sideways consolidating for 3 years. Check out the breakout. I expect a strong 2018 in this space. Personal products index, straight up move. Currently pulling back down below that rising 20-day moving average. But again, let's take a look at it from a longer term perspective. Lot of sideways consolidation, recently making a break. It'll be really interesting to see what happens when we get down to that rising 20-week moving average. At that point, I would suspect that we will bounce back to the upside. And so with that, let's go ahead and summarize. We did take a look at a few different things. We looked at the major indices, gave you the overall market review recently, took a look at some relative ratios I find very bullish. I would avoid commodities, and then went through a number of various sectors, industry groups to give you some ideas for 2018. So with that, I'm going to turn it back over to Erin.
Yes, and it is time for the 10 and 10. I'd like to give you a little bit of a break, but no such luck. So we're going to start off with Facebook. So FB, it's an interesting day for them, but reaching some interesting support levels.
Yeah, Facebook was getting hit pretty good. And actually, I was talking to Greg Schnell earlier today, and apparently there was a survey out that said if you could only give up one, or if you had to give up one of the really big players in the tech space, and they mentioned Facebook, Apple, Google, and Amazon. If you had to give up one of those, which one would it be? And 75% of people said Facebook.
Wow.
Yep.
That's
so
interesting.
Yeah, I'm not sure what that does for the price of the stock, but anyhow, that was kind of interesting. I like the hollow candle. I mean, we had a big gap down. They were talking about something about the news feed, and for me, and I do use Facebook. I don't use it a lot, but I use it, and the news feed to me is just annoying. So I don't know what they were changing. I really didn't look into the stock or into that news item much, but I think that's what was fueling the selling at the open. But if you look, the open was pretty much
screen, huh?
Oh, yeah, that's right.
Yep.
All right, so here's Facebook. Here was the gap down, so you can kind of see. Let me take a look here. You can see that the open, anytime you have a hollow candle, your open is at the bottom, and where you are currently is at the top of the hollow rectangle. So you can see we actually opened down here toward the low of the day, and we've been rising ever since, and we've been doing it on really big volume. And I know, Aaron, one of the things you look at is the on balance volume, and there are others who use a similar accumulation distribution line.
Mm-hmm.
And the way that, and I believe it's the on balance volume that would show this as a negative because you're down for the day. And I think accumulation distribution line actually would show this as a positive because you're in the upper half of the candle. And that's the difference between those two. Just wanted to mention it because anytime I see a huge volume move like this, it's going to heavily influence. And maybe even during the mailbag, if we have time, maybe you can pull this one up and illustrate with your charts the difference between the OBV, because this will be a really good example. But technically, I'm still not a big fan here. I mean, I do like the fact that it is bouncing off, but we're sitting about where we were a couple months ago. And when you consider where the market has been and where it was a few months ago, Facebook's really not performing well on a relative basis. On an absolute basis, it hasn't broken down. So it's not like I'm bearish the stock, but we really haven't done a whole lot over the last couple of months. And so for that reason, I would probably just be sitting it out or maybe sitting on the sidelines with this one. But, trying to find maybe a good level, maybe just kind of watch a trend line that's going to be something like that. Is something maybe to pay attention to. You got a recent low. I'm going to draw a couple of these auto support resistance lines. That's the recent low. There's the low before. So I think this is a key zone for Facebook from a more intermediate term perspective. I think as long as it holds there, if I was in the stock, and you don't mind waffling for a bit, then that's an area that I would watch and maybe hold Facebook for now.
All right. Let's revisit one we haven't looked at in a little while. Ultra Clean Holdings, UCTT.
All right. It's in a downtrend. I do like the gap up, and I like the hammer from a couple of days ago. So let's annotate this. But the hammer that I'm referring to is right here. So you've been pulling back. You were in that gap support zone, almost filled the gap, and then came rallying back up again. I think as long as I continue to hold, say, around $22, I'd be okay here. But if you close back below 22, you're also losing that 20-day moving average. MACD is just sitting here trying to, figure out where the next move is. A breakout above 24.50, I think, would be very bullish. So I'm going to put a little line in right there because I think if you get through that level with increasing volume, I think that would be an indication that this was really more of like a bullish wedge that we broke out on volume. I think confirmation comes on a move and a close through 24.50.
All right. Interesting chart right now, at least on my screen, is AMD. I'm seeing a symmetrical triangle. Could be considered a island reversal, but I don't see that. A symmetrical triangle as continuation pattern. And I'm just now getting a 20-50-day EMA positive crossover. So that would give me an intermediate term buy signal.
Yeah, I think for me, with the heavy volume coming in on that gap, I think the open there, along with the reaction low, and then possibly if you want to throw a third level in the bottom of gap support, but on heavy volume and a move up, I really don't want to see it go back down to 11. So, and I think what Aaron is referring to is just a very short-term triangle. So let me pull this up.
Yes.
So kind of looking at something like that, ignore the arrow on there. But basically, you got to move up, and you are sideways consolidating in a symmetrical triangle at this point. And a breakout, clearly a breakout above 12.25 with heavy volume. That's what you're looking for here.
All right. Next one is U.S. Steel, X.
Yeah, I mentioned steel, and actually we talked about steel a while back, USX, a while ago. And if you look at, and this was back when it was trying to challenge, I remember this gap resistance level. And once we got through, things really started picking up here. And the index itself is very bullish. That was one of the industry groups that I mentioned during my market forecast. I like the group. I mean, it's an overbought stock right now. So the only thing really that bothers me here is just the fact that it's overbought. I don't like to chase. So I would have to maybe pause and wait to try to get a better entry. But there's your blue mountains. Anytime you get the readings above 70 on the RSI, you get these blue readings, blue mountains. And I don't like chasing stocks. Now, the argument could have been made here. Well, it's breaking out. And so what? Overbought can remain overbought. And that would have been a perfect case for staying long here. But there are also a lot of indications, or there are a lot of other stocks that when you get these overbought levels do pull back and consolidate for a period of time. You can see here when you went right up above 70, what happened for the next few months. So it's not always, it's always easy to look back 2020 and say, well, overbought can remain overbought. I'm going to stay in. Just realize that a lot of times when stocks do reach the 70 level on RSI, it can be a signal of a top. Now, in this case, you were making a breakout, so maybe you could have put a tight stop in and ridden some of this to the upside. If I'm in it, as long as this thing stays above the rising 20-day moving average, I'm okay with it.
All right. Let's see. Next one I have for you is NVCR, Novocure.
All right. Novocure, like the consolidation, the long-term basing, it tried to make a breakout yesterday with very heavy volume. Yeah, I like this pattern a lot. Beautiful move up. And what I'm looking at is just drawing this. Actually, let's just do it this way. That auto resistance line usually works pretty good. So we're trying to get a close above, and I don't know what the exact number is. I'm going to say around 22, 22.10, something like that. We're sitting right under it. You can see that we continue to put in higher lows here. So, it could potentially move back to the lower end of the range. So I'd watch this trend line and the rising 20-day, which has been holding. So from a short-term trading perspective, if I get the breakout, I don't want to hold it if it goes below that rising 20. I certainly am not going to hold it all the way back down here. But so far, we haven't gotten that breakout. It looked like we were going to get it yesterday with volume. Let's see if the stock can follow up and actually make this breakout. But I do like the pattern. I think eventually we'll get higher prices here.
All right. I would say I've got the next one is Rough Dog, DUK. I mean, that space has been doing so well, and Duke Energy's gone the exact opposite direction. I'd say catching a falling knife right now.
Well, that energy in there is actually misleading. It's a utility company.
Oh, well, there you go.
So, I mean, utilities have just been getting crushed. So possibly today we might be getting a little bit of a reversal, but the longer term picture here is so bearish that even if it did bounce, you might get, maybe you could get $2.5 out of it. But again, I'm trying to outperform the S&P 500, and there is no worse group out there right now.
Yes.
Utilities. So I am just not interested because of that. So the thing that I would focus on looking at this chart, if I was annotating, is just this. We're in a market that's been going straight up, and I'm not a value investor. I guess if you're a value investor, maybe it's a little bit more appealing. But I'm looking for momentum to ride the wave, and I don't want to ride this wave.
No, it looks like it's crushing down on us right now. All right, next one is NKTR, and I commented on it a little bit in the chat box, but could be a flag. Too risky for me. I don't like those giant moves like that, but it has some potential.
Yeah, this is on my strong earnings chart list, and I know a lot of folks have asked me about that. It's not something I routinely give out, although I do post a lot of my setup. All my setups actually on Mondays come from that list. So if you like, looking at some of those setups, and you should take a look at my chart list in the Trading Places blog on Mondays. Actually, it's up there every day, but that's when I put up the new ones for the current week. But anyhow, NKTR on this breakout. I know that the earnings were strong. I don't know which day. It was probably over here when that black candle printed. But very heavy volume on the move up. That tells me that the stock is just reeks of accumulation. A lot of folks getting in. And the fact that it did move up so fast and hasn't pulled back is another indication to me that it's probably got more room to the upside. Now, it did break out above 60 on some increasing volume. If we could, my best entry on this stock would actually be if it did have a short-term pullback. And if we could get it back down close to 60, 61, that rising 20-day, is right now at price support. So I'd love to see a quick little sell off on the stock. But yeah, I tend to agree with you a little bit here, Aaron. I think the stock's moved quite a bit, and there's too much risk at this point to jump in. But I do think a pullback down closer to the 60 level, low 60s, and it starts to look a lot better.
Yeah, I'd even be happy with a move back to 65 to continue to set up that flag. All right, next one I have for you is, let's see, HST, Host Hotels.
Yeah, it's been a pretty good group, and I like the move. I like the volume trends. Couple things here. The fact that we were consolidating for a while and then made the breakout, I think that's good. And then once making the breakout here, you can see we did come back down almost right to price support before turning back up again. And so right now, I would say for me, the recent lows are probably the most important area. And you've also got the 50-day. So I view this in maybe a dollar trading range between 1975 and 2075. Closer it gets back to 1975, the more I like it.
All right. Let's see the next one, ALRM, Alarm.com Holdings.
Well, downtrending. This is going to be a battle between positive divergence and a downtrending stock, but I do like that gap up in a fill here. So let me just point out. I mean, this one is you probably have a little bit of a pretty strong reward to risk. You can see first of all that this has been an area right about in here where we've had some really solid support. Maybe let's call it 35.75 to 36.25, maybe something like that. Stock sitting at 36.41. Here was the gap I was referring to. Look at the volume. I don't know what that news was, but if that was earnings related, that would certainly help me. I'd feel a little bit better about it. But then we came back down on much lighter volume, double bottom. I think if we can get back through that 20-day moving average, I would get a lot more bullish. Here was the lower close, by the way, with the MACD turning higher. So you've got a positive divergence and double bottom near support. I could make an argument for going long here. The biggest risk for me in this stock would just be some out of the blue announcement like we had back in November. And you really can't eliminate that risk no matter what stock you hold. It's just that this is a smaller company, and so these tend to be hit a little bit harder if they come out with bad news. But I would look for that 36 area to hold and for the stock to get back up above that 20-day.
All right. And the last one is the Gold Miners Index, the bullish 3x share. So NUGT, it's usually a high in the ticker cloud.
Yeah, I mean, gold's been very strong in the short term. So the NUGT has been a great way to play it. As I mentioned in my outlook, I'm not a fan of gold. Even though gold has been on this move, I still think on a relative basis, gold is not outperforming the S&P 500. And the long-term chart tells me to stay the heck away from it. So that is not an area yet. And I was the same way with energy for a while until we finally started to see strength. We started to break trend lines and relative strength started to improve. I was, had a very bearish look at energy stocks for quite a while. So I just need to see more out of the group. So I don't like gold playing gold. So I definitely don't like playing gold 3 times.
Right.
Leverage. To me, it's just, and again, it's just my personal opinion, but it's 3 times uglier than gold itself. So I would avoid. One thing that I would say is watch the gold chart. And I didn't annotate this because I don't like to annotate leveraged ETFs because they are designed to track an index. And so there's erosion over time. And when you start looking at individual support resistance on the leveraged ETF, it can be very misleading. And I'll just leave it at that because that's really a discussion for another day. But what I will do is just say, I'm assuming that the underlying index or the underlying index is looking similar. But what I would do is go back to the underlying index, the gold miners, and I would watch the 20-day moving average. And if that failed to hold, knowing that the long-term chart is down and knowing that the relative strength versus the S&P 500 is non-existent, I would be out of it. So just keep a tight stop.
All right. And with that, I'm going to give you a summary of what we did for the 10 and 10. The symbols are right here. We will have them posted in the Market Watchers live chart list, where you'll find the link to that in the Market Watchers Live blog. So if you go there, you can look at all of these symbols and what we did with that. And with that, I think we're going to go ahead and do something. Like I said, we haven't done this before, but we're going to look at a watch list, which is basically our Monday setup. So we have 2 to look at right now. So I'm going to share the screen. I did pull up a few 30-minute bar charts of the 2 that we did, and I annotated them a bit. So if you recall, AVAV was Tom's pick, and it's doing quite well, I must say, from when you bought it. When we paper traded, I don't know if you actually bought it.
I did buy it.
You did?
I own it. Yep.
All right, then you're probably really happy right now. So we picked them right around noon on Monday, of course, and you can see sort of where we've been going. I think this double bottom looks really good. The neckline was broken. This area of resistance could pose a bit of a problem, at least in my opinion, but certainly has the momentum going for it. I would be pretty happy with that. I mean, a nice move there. Look at that MACD, very pretty. So that one's doing pretty well. Mine was Faro, Faro Technologies, and I put this on my style of a chart. So I picked it up here around noon, of course, on Monday, and the reasoning being I had a 3-day up move on the PMO. And you can see since then it mostly consolidated over the first day, but we're now in a rising trend channel. Little concerned about this breakdown here, and now it is breaking down below that area of support. So hopefully by the end of the day we'll close or get back above that 52.25 area. So if you want to see exactly how we did, let me go over here. So here's our watch list, and currently, as of the time I printed this chart, so I'm not really sure exactly what our current numbers are necessarily, but as of printing of this chart, we had Tom, you're up 2.1% right now, and Faro is at the time was up 3.6%. So we'll have to see if that pullback's going to end up hurting me by the end of the day. We'll see who's on top on Tuesday, because remember, we don't have a show on Monday. So far, so good, I'd say, on our picks.
Yeah, they're doing well.
Yeah.
Yeah, like I said, I own AV, and yeah, short term, we got a little bit of overhead resistance on that one, but I would be looking, my target on it is back up close to the December high, which was near 58 or a little bit above 58. So
yep,
I'm gonna have a little bit of patience. I know I wasn't born with a whole lot of patience in trading, but I'm gonna try and exercise a little bit. Short term, getting it back above that the falling 20-day moving average would be a good first step. See if that happens.
Yeah, absolutely. So with that, I'm going to move into my sentiment report. Like I said, we had some interesting charts to show, and I'll summarize my thoughts on what our sentiment charts are telling us. I'm going to start with the AAII poll, the American Association of Individual Investors. This is a poll. If you go to their website, you just click I'm a bull or I'm a bear, and there you go. That's how they get this poll. So it's really kind of a wide-ranging group of people, obviously, that are taking these polls. So what I wanted to point out, these are the places where we had a bull-bear ratio above 2, meaning that we had twice as many bulls as we did bears. And if you go above that, it's even more. So we had really large spike last week. Today it's pulled way back, but we're still sitting at 2. So that still means we have twice as many bulls as we do bears. And, it's pretty easy to see that when you calculate it. But, at this point, when I read this chart, obviously people are feeling bullish if you've got twice as many bulls as bears. So that is our AAII chart. And I want to look at the name exposure. And this is the National Association of Active Investment Managers. I believe that's what so we look at their exposure. How exposed are they to the market? And currently you can see they've pulled back exposure, and they continued to pull back exposure. But you can see in the thumbnail, we're just, it peaked up a little bit above the last one. So I would say basically no change as far as their exposure level goes. But it's still, if you look at the reading, It's still pretty high, but it's more in that average area. So I would be looking at this as somewhat neutral as far as exposure, but the fact that it's been pulling back does give me pause a little bit, especially when you're looking at a run like this up to the upside. And now I'm going to show you our very own RIDEX ratio. Decision Point came up with this. And just a quick background, RIDEX, the RIDEX funds are a group of funds where you can track bear funds, bull and sector funds, and money market assets. So Guggenheim, who now handles these RIDEX funds, will post every evening how many assets are in all of these groups. And so we tally that up and we come up with a bull bear, a bear bull ratio. So the RIDEX ratio is what we end up coming up with. And it kind of gives you a feel for, how bullish or bearish people are based on where the money is actually going, not just a raise your hand poll. I feel like this, but then, I feel really bullish, but at the meantime, I'm pulling back my investments, so those can be a little bit wishy-washy. So we really like this sentiment indicator because it's money where your mouth is how I always talk about it. So a couple of things to point out on this. First, okay, here's our ratio. This is an inverted scale. So the more bullish assets that we have, the smaller the number. And so I like to go higher because that's showing me a bullish ratio. That's telling me things are more and more bullish. And when you look at a sentiment chart, it's contrarian. So it's helpful when people are feeling very bullish to put it up on the top where it would be considered overbought. So that's why I have that flipped for the ratio. But what I wanted to point out, and I had talked to Greg about this on Friday when we went over these, we have this ratio that's just been rising and rising, which implies, of course, that we still have more bulls than bears, but we're now seeing an even larger preponderance of those assets in the bull funds. But we ended up getting a little bit of a breakdown this week as far as sentiment. And I do find that bearish for the market. Right now, though, it was very interesting to see that we've got here are bear funds and money is leaving bear funds. Well, the interesting thing is when you look at the equity, the bull and sector funds, money is also leaving from there. And we're starting to see an increase in money market assets. Now, I think part of this is probably due to holidays. A lot of people pulled out of the market on their way out, but we're not seeing them moving back in at this point. So I think that tells us there could be a bit of a problem. There is some people out there maybe hedging that aren't very comfortable. And look at this rising bottoms line on the bull and sector funds. We've now moved down to a spot we haven't seen with that breakdown from that decline or that rising bottoms trend line that I've annotated at this point. So seeing that drop below that rising bottoms line and seeing this starting to poke down below that rising bottoms line, I think we're finally starting to see a little bit more caution starting to come through when we look at the rotation of the RIDEX assets. So let me go ahead and I will summarize this for you so that you can understand where I'm coming from as far as all of this is concerned. Let's look at this all put together. So first of all, remember the put-call ratio. We're looking at bullish readings on that currently. Actually, I didn't show you that chart. Let me go back. I did not show you the put-call ratio. Let's get back here and I'm going to show that to you. All right, here we go. All right, so what I look for, of course, are peaks and valleys. That's where you get the market turnarounds. That's where the interesting information lies. Let's put it that way. What I find interesting right now, looking at the put-call ratios, is we're now seeing lows on these ratios. And we're now seeing the CBOE put-call ratios starting to fall and hit some lows. What does that mean as far as what happens to the market when we hit those lows like that on the ratios. Well, I've marked a few places where we had sort of similar setups here. And you can see that typically you don't want to see that because we end up seeing some either consolidation or decline, as we saw back here in 2017. I mean, not a big decline, but it was still a decline nonetheless on the S&P 100. And now we're heading straight up, obviously, in this almost parabolic rally when you look at a chart like this, which should always give you a little bit of pause. But the fact that these ratios, and again, calls are in the denominator. So the larger that is, the smaller the number is going to be. So when we're seeing these numbers moving down like this, that means people are getting more and more bullish. So these are bullish readings. And sentiment being contrarian means that is bearish for the market. So let's go back to that summary chart. All right. There we go. So yes, the 10-day moving average of the put call ratio, we're looking at bullish readings, and of course, sentiment being contrarian, that's bearish for the market. When I look at AAII, it's very bullish right now. You saw the poll, and so I would say that's very bearish for the market as well. And if you look at the name exposure, I think that's somewhat bullish because they are still exposed and a little bit more than on average. So I think that's somewhat bearish for the market as far as the big name investors go. And RIDEX ratio, money is moving out of the market in both the bull and the bear funds, and we're seeing that RIDEX ratio breaking down. So in conclusion, I think the polls are continuing to show those very bullish readings. Actual money is leaving the funds, so that's telling me that although everybody says they're very bullish, they're pulling their money out of the market. And we're seeing a breakdown of that ratio, that RIDEX ratio, and that is bearish for the market overall. So sentiment, I think right now is pointing bearish. Of course, we're sitting in the middle of a very, very strong bull market. So when I see this, it's bearish for the market, but let's face it, bearish these days means consolidation, maybe a pullback. One day maybe we'll have a correction. But at this point, you can't really bank on that, so to speak. I would be just knowing that money is leaving, that things are starting to look a little bit shaky. This might be that time for that consolidation or even a pullback. So that's pretty much what I had for the sentiment update. And at this point, I guess it's time to just sort of wrap it up. What are you thinking these days right now?
Well, I tell you what, I just was thinking that I'll bring up that Facebook chart.
Ah, yes.
Kind of go over that, just kind of explain that. So let me grab screen and kind of highlight this.
Oh, yes, that's right. The OBV versus the accumulation distribution. And yeah, the main difference between these, the OBV takes into account, basically if it's down day, all the volume is subtracted from the cumulative total and vice versa. Accumulation distribution actually does a proportional sort of calculation based on, as you were saying, Tom, whether the market is closing higher than what it opened. But even though the overall is close that's lower, the fact that the close is above the open would change the AD line, or the accumulation distribution line.
Yeah, I think if it's in the top half of the candle, if that close is in the top half of the day's range, then it'll be an add to the accumulation distribution. But the fact that it's down $6 right now from where it was to begin the day, the OBV strictly looks at, are you up or are you down for the day? That's it. So I kind of, for me, I think, and Arthur has done a really good article in the Chart School. So if you want to go back and review that, I would highly recommend that. But what he wrote in there is that if you're getting a bullish confirmation from both, that's good. Or if you're getting a bullish confirmation or bearish confirmation from both, then obviously that's more bearish. But he highlighted in there how you can get differing signals, and that's the reason for it. So when I look at this, I say, well, I do like the fact that it's a hollow candle, and as long as, and especially with heavy volume, and as long as I'm in an uptrend, I would treat that bullishly. Now, if we had been losing a major uptrend, and even though it had a hollow candle, but we were beneath that uptrend line, if we were breaking a major trend line with a candle like that, I would view it bearishly. So to me, it really just depends on the overall chart. I would not look at that. To me, it's a secondary indicator. It's like what I use MACD and RSI for. I don't trade off of those specifically, right, but they help to confirm a position in a trade one way or the other. And so that's the way I would use accumulation distribution or OBV, more as secondary indicators to confirm what you're already seeing on the chart.
Absolutely. And I agree. That's how I use it. And a lot of people ask me, why not the accumulation distribution line? It's a little more fine tuned. But as I tell everybody, I grew up using the OBV. I was helping my dad calculate it on accounting paper back, gosh, how old was I? I think I was 14 or 15. So I've been doing this with a ruler in the Wall Street Journal, calculating the OBV. So to me, it's so second nature. It's so I'm so comfortable with it that I wouldn't change.
Yeah, I think that's important actually for everybody. I think that you need to have indicators that you are very comfortable with and that you understand why, what they do and how they work and why they work. And I think it's also important to recognize their limitations. I mean, there's,
yes,
I say a lot of times with the MACD, I'm a big fan, but I also admit, on the other hand, the PPO is a better indicator just because, I mean, they're the same. If you look at them on a chart, they use the same moving averages, but one is expressed in percentage terms, the PPO, whereas the other is expressed in dollar terms, the MACD. So if you're looking at two different charts or two different, securities that have varying price levels, the PPO, you can compare the two because you can look at percentage differences.
right.
If you look at the MACD, you can't. If I can't compare Google's MACD with Sirius XM. Sirius XM's $5 stock, Google, $1,000 stock. So you can't compare the two. But if you pull up the PPO, you can. And
Right.
see, is Google 1% above its, the 12 period moving average is at 1% above the 26 period. You can compare that to Siri because they're both in terms of percentages. The other thing there was another question that had come in, so I figured we'll go ahead and answer this one before we wrap up.
Mm-hmm.
But the question is on a stop. Do I use a intraday, just a hard close, a hard stop, for selling? And my answer is I'm able to watch the market throughout the day for the most part. And so I rarely use a hard stop. So as an example, I'm going to be watching AVAV. This is one of my trades. But the thing I liked about AVAV is this gap up with earnings. And it opened at 52.52 and continued moving higher. So I think that 52.52 level is very big. Also, you can see the low of the day is 52.10. So I think that is a really key support zone on this stock on the way down. So if it were to move, first of all, if it closed below 52, I'd be out. Intraday, it would probably start making me pretty nervous if it got down around 51.50. I'd have to see the volume. And so I might have a stop on it. And let's say it goes down below 51.50 and I have a stop, I get taken out with a small loss. Sometimes that particular day, I'll actually put back on a stop buy, meaning that if it gets back up to say 52.10 or maybe it's that 52.50 level, a lot of times that's where you get a major bottom, is when folks get stopped out and then the stock reverses back that same day and holds on to support at the close. So I have in the past been stopped out intraday and then gotten back in. And what I'm doing is I'm essentially just sacrificing the key support level down to where I took the stop. So in this case, say 52.50 down to 51.50. I'm willing to sacrifice that 2% to avoid a major, big move down where it might go all the way back down to the bottom of gap support. But then if it comes back up and holds 52.50, I'm willing to take another shot with it. I'm not saying I do that with every trade, but sometimes when I get stopped out intraday because I don't want to take a big risk, sometimes I do get back in. And by the way, I would say that's the hardest thing about trading is managing
Yes.
stops on a intraday basis.
Yes. And, for me, I don't always use a hard stop. But for me, I'm not glued to my computer the entire market day. Um, I'm a social person. I love this broadcasting thing much better than sitting and staring at my screen all day by myself. But yeah, I'm more of an intermediate term trader, so I'm not always, going to be watching it every day. So that's why I will tend to set a longer term type stop. Although most of mine, admittedly, are mental and not actual, if you want to say so.
Yep. Well, I would just say that I don't watch the market all day long. I do take water breaks.
and other breaks, TMI, we won't talk about, but
all right. Well, we are ready to wrap things up for the week. First, just want to thank everybody for tuning in. You can see on your screen some of the upcoming schedule. Check that out. Greg Schnell tomorrow with Stock Charts Outlook. No market watchers on Monday. Of course, stock market is closed. U.S. market's closed for the Martin Luther King holiday. And then next Wednesday, we have Tom McClellan, another great guest on the docket. So make sure you mark your calendar for next Wednesday, the 17th. As you leave, please complete the exit. We'd love to get your feedback to hear what you think of Market Watchers Live. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great long weekend, everybody. Be safe, and we'll see you back here on Tuesday. Happy trading.